Welcome to Perspectives, a Canadian journal of political economy and social democracy. My name is Clement Nocos, editor of Perspectives Journal and director of policy and engagement at the Broadbent Institute. In case you missed it, earlier this April we released the first issue of the Perspectives Journal, which you can now find online, and for those of you at the 2024 Progress Summit, you can purchase a limited print run copy. This initial release of the Perspectives Journal sets up the arena for debate among the progressive left of ideas and their applications for a more equal and just Canada. A guiding thesis behind our new publication that's come to light since the passing of Ed Broadbent earlier this year comes from Ed's very own dissertation entitled The Good Society of John Stuart Mill. The journal's first release alongside the 2024 Progress Summit themed Making the Good Society looks to survey this idea taken from Ed's conclusion that it is clear in principle that only a collectively owned economy can avoid exploitation and thus make the good society realizable. It remains to be seen whether a nation, while rejecting Mill's normative economics, can retain his other social values and so make the cooperative individualist life a reality. In today's apparently well-performing capitalist economy, working-class, ordinary Canadians aren't feeling like they live in the good society. According to the Broadbent Institute's recent research report, linked in the show notes below, housing affordability is clearly a top concern for people living in the most expensive cities in Canada, and dramatic curves in housing increases, among other things for everyday life, are making many feel angry and disenchanted with society. Our report shows that top of the list in culprits of actors people believe are behind the housing affordability crisis are foreign investors, though Statistics Canada in 2020 finds they only make up about 2 to 6% of all housing investment in Canada. Still to top the list are the federal government, real estate developers, and corporate landlords. There's a clear identification of financial actors behind the housing crisis, though nebulous in which actors in particular. But given this popular perception, who's actually behind the financialization of housing in Canada that's felt every day by working-class Canadians? In part 1 of 3 for the first issue of Perspectives Journal, housing policy researcher and PhD candidate at the University of Toronto's Department of Geography and Planning, Jeremy Withers, dug into the data that demonstrates a dramatic rise in investor ownership of housing. And he joins me on the show to chat about his new analysis. Jeremy, welcome to the Perspectives Journal podcast.
Yeah, thanks for having me.
Now, before we get in too deep, I think we ought to define a few things first. When people see financial actors as behind the rapid increase in housing prices, they sometimes like to call it the financialization of housing, to the chagrin of a lot of policy wonks on Twitter. So before we start off, could you help us define what we mean by financialization?
Sure. So financialization is a concept that it attempts to focus attention on a structural transformation that's taken place across national economies around the world since the 1980s. And this has involved, on the one hand, a substantial increase in the size and the profitability of financial actors like banks, institutional investors, and their kind of increasing dominance relative to other economic actors, coordinating wealth accumulation, capturing and siphoning off much of that growth. And so, for example, whereas in the post-World War II era, we may have thought of industrial commodity producers like General Motors and General Electric as the most powerful and profitable actors in capitalism, I think today we're more likely to look to financial actors like Blackstone and Goldman Sachs. And so at the same time, financialization as a concept also seeks to describe broader changes transforming how other actors operate. So large non-financial corporations are increasingly reliant on financial activities like lending, investing, share buybacks to accumulate wealth. And that's rather than through, trade and the production of commodities. And of course, governments have become increasingly reliant on levering up on debt to support day-to-day operations, as of course have households, which in many rich countries, and especially in Canada, have levered up on historic amounts of mortgage debt in recent years, as the ownership of housing has become pivotal to the accumulation of wealth, of household wealth in many families. And so this transformation has been has been spurred and enabled by pretty wide range of neoliberal policies, which Anglo-American countries have really led the charge in implementing in the 1980s and onward. One of the most important of these has been the push to what's referred as deregulating or liberalizing the finance sector. And the listener won't be able to see I'm using square quotes over the term deregulating, because it's more precise to describe this as a re-regulation of finance to grant financial actors much more power and leeway to determine how much debt they want to lend out and to whom. At the time, the idea put forward by lobbyists and neoclassical economists was that if financial markets were given freer rein to determine how much credit should be lent out, this would create strong growth in productivity and ultimately GDP as investments were channeled into kind of innovative new productive techniques and sectors. But ultimately, while this re-regulation of finance has led to huge increases in indebtedness and leverage throughout the economy, very little of it has been directed towards productive activities. Instead, what we've seen is a notable slowdown in the investment going to new machinery and research and development in many countries, and an overall slowing in the growth of productivity and economic growth. And this concern over secular stagnation and debt overhangs has become widely acknowledged today, even among mainstream economists. Martin Wolf, for example, the chief economics commentator for the Financial Times, has recently argued in his new book, and I quote, financialization has proven to be far more a vehicle for rent extraction than productive investment, with little of this expansion in financial balance sheets financing fresh investment, end quote. So, where has this credit gone instead? Well, it turns out the vast majority has been channeled towards bidding up pre-existing assets, above all into real estate. And I really want to underline this point because the stats are pretty staggering. So a recent study from the National Bureau of Economic Research in the US found that over the course of the 1990s and 2000s, on average among most rich countries, credit from banks, that is debt, actually grew at nearly double the rate of national income. So that's double the rate of GDP. When the study asked where this growing overhang of debt has been invested, it found that nearly 90% of that increase of outstanding debt from banks was mortgage debt. So it's being pumped into real estate.
That was a great overview of financialization. It sounds like a bigger picture when it comes to the entire period since the 2008 Great Recession, what markets and the financial sector has done. But could you also explain then, how is this big expansion in financial activities and mortgage debt then affected the price of housing and the affordability of housing?
Sure. So scholarship on the financialization of housing has, as I was just saying, focused attention on how this surge in mortgage debt and demand for housing has really transformed local housing systems around the world into which it's being channeled. And so while this process is, of course, highly uneven, and its outcomes to a great extent depend on how home prices and rents are regulated in different areas, how housing wealth is taxed, we can certainly speak to a common pattern which has been identified by many studies. And first and foremost, that's the close connection that tends to develop between rising access to mortgage debt and rising home prices. And this dynamic can quickly become mutually reinforcing and produce booms and bust cycles. And this is a process that political economist Josh Ryan Collins has called a housing finance feedback cycle. And it's important to note off the bat, this pattern of debt-driven home price booms, it's not simply the result or the inevitable outcome of a surge in mortgage debt. It's very much driven by the interaction of that added bidding power that comes from mortgage debt with a local system in which housing is predominantly treated as a commodity to profit off of, and home prices are predominantly allowed to be set by the market, that is to say, by the highest bidder. So these feedback cycles are often spurred by governments loosening regulations on mortgage financings. For example, they could reduce down payment requirements or increase the length of time mortgages can be paid off. And for those buyers who are competing to buy housing, it becomes necessary to borrow more and to bid higher in attempt to acquire the home. And this in turn leads to a feedback cycle whereby as prices escalate, mortgage lenders will then lend more and more because they see the loans are backed by pretty high quality collateral. And then home buyers who develop these extrapolative expectations that prices are going to keep going up, they become increasingly willing and able to lever up on as much debt as they can because they're afraid of missing out. So the upshot of all this is demand gets hotter and hotter, buyers get more indebted, prices grow faster than local incomes. And ultimately, this leads to economies to be particularly vulnerable to economic shocks. Now, on the one hand, these debt-driven price booms, they're inherently unsustainable. There's obviously a limit to how far home prices can decouple from incomes. And this is, of course, something that was made painfully clear by the popping of the US housing bubble that triggered the 2008 global financial crisis. On the other hand, these debt-driven booms can be extended and amplified when they attract additional demand from wealthy investors who see these prices bubbling up and get keen to get in on the action. And so this is an important second aspect of the financialization of housing. And over the past 2 decades, but really ramping up over the past decade, we've seen a growing share of the housing stock in many countries being bought out by wealthy individuals and corporations who are trying to build up portfolios. And this famously includes, real estate investment trusts and private equity firms that are on buying sprees, acquiring mostly aging purpose-built rental apartments, and then aggressively trying to raise the rents and often displacing lower income tenants and gentrifying these projects. But another aspect of this, which I think has, until fairly recently been under-discussed in Canada at least, is the rise in demand from wealthy individuals and also corporations for single-family houses and condo apartments. Unsurprisingly, it's broadly documented that areas experiencing this added demand from wealthy investors, they've seen substantial declines in affordability and rising prices. Declining rates of home ownership as households try to buy a home are outbid and forced to rent, often in the very condos and houses that are being acquired by these multiple property owners. Now, standing back from all this, this growth in demand from investors, it can certainly amplify and extend this debt-driven boom. But in doing so, it can also deepen the risks of financial instability. And that's because on the one hand, housing investors are often substantially more indebted and leveraged than owners of a single home. And this is certainly the case in Canada, as research from Bank of Canada has identified. And because they're more leveraged than owner-occupiers, they're more vulnerable to economic shocks and more of a liability for the broader system. In addition to this concern, investors are also, they're just much more likely to sell, sometimes en masse when there's concern over a local downturn in prices. And, that's because they tend to be fairly single-mindedly focused on wealth accumulation. They're far less bound to the local community and to the homes in question than people who've made a home there, have kids in school. So what my report sought to do was to give a bit of an overview of how these trends have evolved in many rich countries around the world, but then focus in on Canada, where these trends are particularly advanced and have really intensified over the course of the pandemic.
And so with regards to this financialization that's played out across Canada, how does this connect then with the rise, in your article, you point out the rise of investor ownership of housing. How does all of this financialization turn into what we see as growing investor ownership?
Yeah, so as I discuss in my report, in Canada, we have a distinctively deep level of state involvement in underwriting and channeling funding into the mortgage market. And this has really ramped up since the early 2000s when our National Housing Agency, CMHC, extended its activities from not only insuring mortgages, but also buying mortgages from other banks, packaging them together into mortgage-backed securities, and then holding onto them. And for anyone interested in the history of these policies and their direct contribution to huge increases in mortgage debt over the past 2 decades, there's some fantastic papers on the subject by Alan Walks, who's a professor at U of T. So between 2001 and today, the value of all mortgage debt, inflation adjusted in Canada, rose from just over $500 billion to $2 trillion. And over the same period, the value of household disposable income, it grew far slower. So from just over 1 trillion to 1.6 trillion. So whereas income grew by a little over half, mortgage debt, more than tripled. The amount of leveraging has made Canadian households among the most indebted in the world. And this has provided the fuel for this huge escalation in home prices. So since 2011, the sales price of an average home in Canada has increased at just over double the rate of the disposable income of Canadian households. And this means that Canada is very close to setting the record for one of the fastest escalations in home prices relative to incomes over the past decade of any country in the OECD. It's second only to Portugal for this level of decoupling of home price to income ratio. And when we look at these surging prices, it's natural to ask, how are people buying at these increasingly unaffordable rates? And of course, we've talked about how the explosion in mortgage debt goes a long way to helping to explain this, and the increasing reliance of many buyers on additional supports from relatives. But this is only one part of the story. And the other part of the story, which my report really focuses on, is the shift that's taking place in terms of what types of buyers are actually taking on this debt and buying this housing. And it's important to shift our lens on affordability here a bit, because While these surges in home prices have, of course, made housing decreasingly affordable for prospective first-time buyers, they've also dramatically increased the wealth of those who already own housing. And as Steve Pomeroy has powerfully outlined, this has supercharged the bidding power and the demand for housing from those who already own housing. So what we clearly see in the recent StatsCan data, which I'm going to go over after this, is that over the past decade or so, as wealthy Canadians saw their home values skyrocket, many became increasingly willing and able to bid up and buy additional homes as investment properties. So by leveraging their higher incomes and their existing housing wealth, they've increasingly outbid prospective homeowners.
Now, can you talk about how this investor ownership of housing is spread across Canada? Because what you can see is like in cities like Toronto or Vancouver, obviously these are the most expensive cities for housing. But you also see the same trends across Canada, even among more rural communities, even among suburbs. You see housing prices also increase. And so how have these trends in different cities across Canada played out?
Yeah, so until quite recently, it's been very difficult to assess the full scale of investor ownership. Data on housing ownership across Canada has been quite fragmented. It's often been hard to access. So thankfully, in 2017, Statistics Canada was mandated to try to address this through a new program called the Canadian Housing Statistics Program. Just over last year, they began to release data sets that tracked investor ownership. So as of late 2023, these data sets have been released for British Columbia, Manitoba, Ontario, New Brunswick, Prince Edward Island, and Nova Scotia. And essentially, this data tracks, homes that are not their owner's primary residence, typically either rented long-term, rented short-term through platforms like Airbnb, or used as vacation homes, or simply left vacant. And it's worth noting that the units that are attached to a primary residence, like a basement suite or a laneway house, they're not included here as an investment property. The data set does track those, but those are not I'm not including those when I'm describing investment properties here. So analyzing the data, we can find that investors have acquired between 14% and 26% of all single-family houses in these provinces as of 2021. And for condo apartments, investors have acquired a substantially higher share, with 30% of all condo apartments in Manitoba owned as investment properties, 37% in BC, and in Ontario, 42% of condo apartments. And so when we look at the data more closely, a pattern jumps out quite immediately, which is that investors are especially targeting recently built housing. Across BC, for example, of all the condo apartment units that were completed over the 5 years preceding 2021, 49% have been acquired by investors. In Ontario, investors have acquired 57% of all recently built condo apartments. So when we zoom into these provinces, largest census metropolitan areas, a similar pattern emerges, whether across Vancouver, Victoria, or Kelowna, or across Ontario's largest urban areas. Investors typically own the majority of recently built condos and between 20 and 30% of recently built single-family houses. So while the data makes clear that investor ownership is quite widespread across these provinces, it's also worth mentioning it's notably concentrated in the core of these urban areas. So for example, whereas in the city of Vancouver, 42% of all condo apartments, and 17% of all houses are investment properties. Across the suburbs that make up the rest of the census metropolitan area of Vancouver, investors own 30% of condo apartments and 12% of houses. And a similar pattern can be seen in many other metropolitan areas. But nonetheless, investor ownership is notably widespread when you consider the provincial averages are quite similar compared to a lot of these metropolitan areas.
And so, even more interesting than the disparity between different communities across Canada is that you also track in your article how the share of investor ownership has risen over time. Could you describe those findings and maybe what's behind that increased over time in investor ownership?
Yeah, so to what extent has the concentration of investor ownership grown in recent years? Unfortunately, the new CHSP data set I was describing it's not very helpful for answering this, as it only goes back a few years. So to answer this question, I had to turn to other Statistics Canada data, which tracks changes in the number of single-family houses which are being rented out. And since 2011, it's also tracked changes in the number of condo apartments that are rented out. So I look to these changes in the number of units that are being rented out as a useful proxy for changes in the number of investment properties. Of course, it's important to recognize it's an underestimate as it doesn't account for those investment properties that are being rented short term through platforms like Airbnb or left unrented. But we can confidently say it does account for the vast majority. So looking at this data, we find that between 2011 and 2021, across Canada, the number of condo apartment units rented out as investment properties nearly doubled. It rose from about 380,000 to over 681,000. Because the number of condo investment properties grew at about double the rate at which the overall stock of condo apartments expanded, investors increased their concentration of ownership substantially. So it rose from about 33% of all condo apartments to 42% across Canada. We can also look at investor ownership of single family houses, and we find that between 2006 and 2011, the number that were owned as investment properties and rented out rose by just over 8%, which was roughly the same pace at which the actual stock of houses were growing. But between 2011 and 2021, we see a 31% increase in the number that are owned by investors and rented out. And so the concentration of ownership of houses also increased. It rose from just over 11% of all single family houses to almost 14% across Canada. Now, these numbers are Canada-wide, but my report also tracks the rate of growth in each province. And I encourage you to read it to see how these trends have evolved. I think one of the really notable takeaways is the province of Ontario has seen by far the fastest growth in the concentration of investor ownership. For both houses and condo apartments, investor share of ownership grew notably faster than any other province, and almost 50% faster than the Canada-wide rate. So Ontario is really leading the charge with these trends, although we are certainly seeing these trends take place in every province in Canada.
Yeah, no, those are certainly interesting trends and patterns in the data, which you also say have important policy implications. Just wondering if you could spell out what this actually means for public policy in Canada.
Yeah, so there's two types of housing investors appear to be especially targeting when we look at these numbers. First, condo apartments and also recently built housing. And it really stands out that in most provinces, investor share of condos is between 2 and 3 times higher than their share of houses. And considering condo apartments are far and away the most affordable type of housing for sale in almost any city across the country, this will be particularly concerning for those trying to buy their first home. It marks a pretty major change from decades past when condos typically provided their starter homes for first-time buyers or options for empty nesters that were downsizing. And the other type of housing we see investors especially targeting is recently built housing. And in the report, I have a few charts that show a pretty stark pattern playing out across Canada, in which investors own a substantially larger share of newer housing than older housing. And it bears repeating, these numbers are really high. So again, in most of the larger urban regions in BC and Ontario, the majority of recently built condos, and between 20 and 30% of recently built houses have been bought by investors. And so there's some pretty important policy implications I think we can draw from this. On the one hand, many people might look at this and say, well, that's okay because investors, they're probably mostly buying newly built properties, but then they're selling them to owner-occupiers after holding them for a few years. Maybe there's some kind of filtering function at play here. The problem is that when you look into this, you find that that's not at all what's actually happened over the past decade. So since 2011, investors increased their share of ownership of both condos and houses that were built in every single historical period. Whether this is housing built in the 80s or before, or the 90s or the 2000s, the 2010s, investors grew their concentration of ownership. They bought more units than they sold over this period. And so the data, makes quite clear that prospective homeowners are being increasingly outbid and crowded out by investors. And that's whether they're trying to buy in the sales room for new housing or trying to buy older housing in the resale market. On the other hand, the fact that investors are buying such a large share of recently built housing raises some doubts about the extent to which policies that are focused on spurring the supply of condos and houses can be expected to make that housing attainable. In the absence of some pretty significant policy changes, the evidence suggests that much of this new housing supply is going to be attained by wealthy Canadians and corporations rather than ordinary Canadians that are trying to buy a home. And these trends are certainly not inevitable. They're the result of policy choices. And when we see our federal government or provincial or municipal governments setting quite vague housing supply targets that just put forward the number of housing units they want to see built over a certain period, it's important to make sure they're also asking what type of housing. Will it help to meet the needs of local renters and prospective owners at a range of income levels? These targets should be identifying and implementing policies that are necessary to supply those needs and putting in place, restrictions on the speculative demand that's not necessary for doing so and that frankly makes it harder to reach those goals.
with the increase in these private investors, some would argue that we need to see more private sector investment in housing. But, you go on to say in your article that investor ownership is a growing concern. How is this a growing concern if it's not to be celebrated like some others would have you believe?
Yeah, so one of the responses you often hear when talking about the rise of investor ownership is, well, who cares? Investors are bringing capital, they're sending a signal to developers to build more, and we need more housing. So underlying this response is, of course, a legitimate concern, which is Canada's a fast-growing country. A lot of people want to move here. We need to figure out as a country how we're going to marshal the funds to house them. But I think that this argument also quite seriously overestimates the need for these types of speculative investors to actually supply that housing we need. And at the same time, it seriously underestimates the role of investor demand in helping to drive our affordability crisis and make our economic system more vulnerable to shocks and financial instability. In my report, when I say this is a growing concern, I'm not just referring to the concerns of renters locked out of homeownership or left-wing affordable housing advocates. I'm talking about as well the repeated warnings that we're hearing from institutions like the Bank of Canada, which is regularly raising red flags about, and I quote, strong demand relative to supply being added by housing investors, heightened bidding pressures and rapid price increases that they're contributing to. And there's extensive international research on this issue, which identifies a close association between a rise in investor demand and boom-bust cycles. And so to respond to your question, of course, we need investment to build new housing, but policymakers can and should be discerning about working to channel that investment to supply housing that's responsive to local needs, at the same time restricting the type of speculative demand that's not, and that's just bidding up pre-existing housing and increasingly concentrating the control and ownership over it. So when we talk about restricting certain type of investor demand, I think it's useful to nuance that conversation. There's no doubt an important discussion to be had about the pros and cons of putting in place restrictions on investor purchases of new build housing. We can talk about that in a moment. But I think we can start by saying it's pretty hard to see any benefit in allowing investors to keep buying up, existing condos and houses which have already been built. There's a strong argument for restricting investor purchases on the resale market. Now, many housing investors will respond to this by saying, well, actually, there's a benefit that comes from investors buying condos and houses, and that's they're helping to expand access to rental housing. And on first glance, this seems reasonable, until one recognizes that in doing so, they're also creating renter demand. And that's because when an investor succeeds in buying a condo or a house on the reseller market, they've done so by outbidding someone who doesn't own a home but would like to. In Canada, since 2011, we've seen a historic decline in the home ownership rate and a major increase in the number of upper income renters. Many of these are affluent renters that have been priced out of home ownership and crowded out into a persistently low vacancy rental market. So certainly a central housing goal right now should be to shift housing supply, to expand access to stable and affordable rental housing. But I think it's quite misguided to suggest we can do that by reshuffling the ownership of our existing stock and in doing so directly contributing to that rental demand we're trying to supply.
That's great. No, and lastly, we heard from the federal government as part of their attempt at addressing housing affordability ahead of the 2024 budget, just a slew of new policies aimed at relieving these housing affordability pressures. But maybe one thing for analysis here, how do the new federal policies deal with housing investors?
Yeah, so the short answer is hardly at all. So as part of the announcements for Budget 2024, the Liberals are proposing to study policy options to, and I quote, restrict the purchase of existing single-family homes by very large corporate investors, end quote. So it's not entirely clear how this policy would apply. It seems like the proposal would involve restricting corporations from buying single-family houses on the resale market. Certainly I think this is a step in the right direction. It's going to help slightly reduce speculative demand for this already existing housing and hopefully help channel this investment towards more productive ends, like building purpose-built rental. But it does beg the question of how many houses are actually being bought up by corporations? And the answer is that up to the present, not many at all. So in most provinces, 85 to 90% of the houses that are owned as investment properties, they're owned by wealthy individuals. Corporations own 10 to 15% of these investment houses. So most of the demand, investor demand for single-family houses is coming from wealthy individuals, and they're not being targeted by this change. Now, this isn't to say that corporations aren't buying up investment properties in Canada. It's just that they've largely been targeting condos. In Ontario, for example, corporations own a third of all condo apartments that are investment properties. In BC, they own around a quarter. So if the Liberals were serious about reducing investor demand for existing housing, they would restrict wealthy Canadian individuals from building up portfolios of this housing. And second, they would restrict corporations from buying houses and condo apartments. But that's assuming they are serious about actually addressing the issue and putting a check on the rise of home prices. And instead, it does seem that, as with their widely publicized ban on foreign housing investors, they're taking quite piecemeal measures. They're only trying to tackle quite a small portion of this additional demand that's coming from housing investors. At the same time, it's certainly a welcome change to see the inclusion rate on capital gains taxes increase. This will apply to capital gains made on the sale of any investment properties by corporations and will apply to capital gains over $250,000 from the sale of investment properties by individuals. These increases, I think, are quite modest. But again, I would say it's a step in the right direction. It is worth noting that it does little to incentivize a shift away from bidding up existing housing and towards more productive activities, because it's going to apply to capital gains across the board. But I do want to offer a bigger picture take on the direction of travel for federal housing policy, because I think the Trudeau government should be given credit for getting much more involved in supporting the development of rental housing than previous governments. And on one level, that's a very welcome shift when compared to the priorities of so many previous administrations to subsidize home ownership and do very little for renters. Since at least the late 1980s and up until quite recently, there's really been very, very little purpose-built rental developed. It's important that we're seeing federal housing policy putting more resources towards pushing a shift to this type of supply. But, zooming in a bit, there is another level on which many progressive housing advocates are looking at this. And that's the frustration that the majority of these funds are being allocated to support a type of private rental housing, which will be by and large affordable only to the most affluent renters and will be owned predominantly by large corporate landlords, which have shareholder-driven mandates, to extract as much rent as they can from tenants. Considering that the government is offering billions of dollars in tax reductions and $55 billion in counting in low-cost financing, I think this is a missed opportunity. One would hope to see far more assurances and requirements tied to this funding, that this new generation of purpose-built rental will be more responsive to the needs of a mix of local renters. The truth is there are very few strings attached to this $55 billion low-interest, low-cost financing fund for private purpose-built rental. The quote-unquote affordability requirements apply to just 20% of the units. They would ensure levels of affordability that are typically well above the average market rents in the areas. And I think most importantly, they only apply for 10 years. One would hope that at the very least, these projects would come with some form of rent control requirement, but it's not the case. And what that means is that in Ontario, for example, since rent controls no longer apply to housing built after 2018, the tenants of these units will have no protection against rent increases whatsoever. So is this really the best we can do with this money? I think it's well established that investment in non-market rental housing creates far more bang for your buck in terms of expanding access to affordable housing. That's because non-market providers have mandates that are much more closely aligned with governments, at least the nominal mandate of our federal government, which is to advance the progressive realization of the right to affordable housing. In non-market, you don't have surpluses being extracted from the project by private interests. Instead, the rents of higher income tenants are being used to cross-subsidize those of lower income tenants. And with time, as mortgages are paid off, any surplus is then reinvested back into building more of these projects. It's pretty basic. And there's huge demand for funding for these types of projects. The housing plan, for example, of Olivia Chow in Toronto is working to develop 25,000 units using this non-market mixed income rent control model. And, yes, it's good to see the federal government funding rental, but it would be great to have a federal government that was willing to step up to the plate and really help fund a generational shift towards non-market rental.
This has been just part one of a three-part series on the rise of investor-owned housing, now available in Perspectives Journal, issue number 1. What are we to expect in parts 2 and 3 of your analysis?
So the next additions to this research are going to focus on how tenants and the rental housing system more broadly is being impacted by the rise of investor ownership. And it's also going to look at policy options for addressing this issue. It compares from province to province the relationship that's developed between, on the one hand, rising rates of investor ownership, condos and houses, on the other, declining rates of home ownership, and the flip side of this, which is the rise in rental demand from upper income renters who are being crowded into a rental system that's persistently tight, persistently low vacancy. And so I also look at how tenants that are living in investment condos and houses are far more vulnerable to eviction than in purpose-built rental apartments and far less capable of organizing to defend their rights. It's been inspiring to see so much pushback against above guideline rent increases by tenants organizing purpose-built rental buildings, organizing rent strikes, and there've been great victories to defend their rights. And try organizing a rent strike in a condo. See how long you last with that. So the Future series also looks at who actually owns these investment properties. And looking from province to province, we find that only a small minority are owned by non-Canadians, despite all the discussion of foreign investors. And really the vast majority of these are owned by wealthy older Canadians. But of course, also many investment condos are held opaquely through corporations. In conclusion, the analysis looks at public policy options that are available to address the issue. It outlines some of the fairly piecemeal policies which have been implemented in Canada recently, such as the restriction on foreign buyers, on home flipping, and on empty homes. And it gives a preliminary assessment of their impacts to date. And then it looks to some of the policies that have been implemented recently in countries like the United Kingdom, New Zealand, and the Netherlands, and gives an assessment of their outcomes. And ultimately, the analysis lands on a number of recommendations. Among these, it calls for added taxes and restricted access to finance for those buying investment properties on the resale market, extending rent control to all units, new and old, occupied and vacant. And in the longer term, it calls for, on the one hand, large-scale development and acquisition of non-profit rental housing. And on the other, broad-based density increases and upzoning, but at the same time tying these upzoning with inclusionary requirements to make sure that new developments are accommodating residents with a mix of incomes.
Jeremy Withers, thank you for joining me today on Perspectives Journal podcast.
That was a pleasure.
That was Jeremy Withers, housing policy researcher and PhD candidate at the University of Toronto's Department of Geography and Planning. Again, you can read his full article in issue number 1 of Perspectives Journal at perspectivesjournal.ca. Join us for the 2024 Ellen Mixon's Wood Lecture featuring economist Isabella Weber at Toronto Metropolitan University on Thursday, May 30th. Earning scrutiny and then vindication for her thesis on sellers' inflation, how corporations use economic shocks like the pandemic to increase price inflation and shareholder profits, Professor Weber will be delivering her insights for the first time to a Canadian context. The event, hosted by the Broadbent Institute, recognizes the legacy of scholarship and Marxist thought by historian Ellen Mixon's Wood with a prize and lecture in her honor. Tickets for this event are now available. Please visit broadbentinstitute.ca for more information. And if you like this interview, share and subscribe to Perspectives, a Canadian journal of political economy and social democracy on all major podcast platforms, as well as Press Progress's Sources podcast that digs deeper into the news stories you won't find in the major papers. The Perspectives Journal podcast and Sources are proud members of the Harbinger Media Network, Canada's progressive podcast community. You can read more in Perspectives Journal, a publication of the Broadbent Institute, by visiting perspectivesjournal.ca.